Welcome to the Hello Seattle podcast, a local perspective on living in and moving to Seattle.
Yeah, we're excited to introduce you to people, places, and communities that make living in our hometown special.
Hello Seattle. I'm your host, Zach McDonald, and real estate agent.
And I'm your host, Dan Keller, your mortgage guy, Dan. We got a great episode today.
I mean, don't we always have a great episode?
We got a recap of an in-person event that I was able to throw last week for local real estate agents, local lenders, where I was able to bring in my space in the mortgage industry, one of the, if not the top economist in our space. And I don't know, you were in attendance. Was it good? Did he deliver?
I'm the one that said we need to talk about this today, right?
Yeah.
I think the point of that event was so that you were educating loan officers, local agents, talking about the market and some of the data. And we've talked about here on the show that we don't think that the housing market is crashing. In fact, we've talked about how we think it's going to be picking up here very soon. It already has been picking up. And the time that we spent together was geared towards showing the data behind those comments. Not just, this isn't our own thinking. This isn't us just being hopeful that things are going to get better, but actually looking at data going back, 50 years, 60 years. We're going to go back and we're going to dive into this. And the whole idea was that this would be information that everybody else got to be aware of as well. The news and the media doesn't usually talk about this kind of stuff. So I'm excited about today. And the reason that we're doing this is because I think this is valuable for people that are thinking about buying a house or moving to the area, but really this is probably valuable for anybody in the country.
Oh my goodness. This is valuable if you own a home. This is valuable. I believe this is valuable if you are thinking of buying a home this year. And I do want to make everyone aware of this. In reference, the economist we're talking about is Barry Habib, and Barry and Dan Habib, they run MBS Highway. Now, they've won consistently year over year. They call it the Crystal Ball Award. In the economist industry, because they're as close as they get as close as anyone can to that crystal ball. Prediction.
I mean, that's what everybody wants. It's hard to predict the future.
Yeah,
that's actually
but
possible.
Know this, if you're listening, this isn't just unlike the media. The media has an objective. The media has an agenda. This isn't just geared toward why you should own a home, why you should buy a home. Sometimes I've been following these guys for 14 years, and sometimes their presentations, economic presentations, aren't super sexy when it comes to real estate and mortgage. So just know that this isn't biased to just, us pitching the benefits of home ownership. This is economic data. It's a 2024 economic forecast for real estate agents, mortgage lenders. And the really great thing about this presentation too, is they were speaking to mortgage professionals and real estate agents so that they could arm us with the information that we need when we're talking to clients. And so that's why I think we felt like it'd be great to share with you guys.
Yeah, well, I'm excited. So why don't you start us off with this recap now that everybody's excited to hear it?
Well, I think we need to start off by, just like they did, and start off talking about things that move real estate and mortgages. Well, if you're in real estate, what does help with moving real estate is how low or how high mortgage rates are, right?
Of course, yeah.
So that's probably, if you're on the real estate side of it, you're like, the leading indicator in regards to how hot the housing market's going to be, one of them is going to be how high or how low mortgage rates are. We saw that over the last 2 years, where we made a jump from 3.8% 30-year fixed rates to 8%.
That's like more than double the rates.
Almost tripled in a less than a 2-year period. But if you even go back over a 4-month period, we went from the 3s to the solid 6s literally overnight. And so what did that do? It slowed down housing
for sure. For sure. It took the demand away.
It also took a demographic out of the housing market away, which we talked about this a minute ago, the move-up buyer, right?
Well, and something that you shared a few weeks ago on the podcast was the dollar amount for every percent of mortgage rate, how much extra that payment was.
Yeah.
And you shared that it was $650 a month per percent. And I don't remember what all the qualifiers are, what the down payment amount or loan amounts were.
We were in about the 700-ish thousand loan amount. So yeah, a point and a quarter, I think it was, made a difference of about $100,000 in purchasing power, meaning the payment stayed the same, or the payment would drop by about $600 a month.
So if you owned a house, let's say it was worth around $1 million, and you were thinking, hey, I'm going to buy the next house that I want. It's actually worth 1.5. In the span of a few months, you went from being able to buy that $1.5 million house and move up into it with a lower rate to you can't even qualify for it anymore. You can only buy your own house again.
Correct.
Right?
Correct. Or if you could qualify for it, your payment was going up to the tune of $1,500+ a month.
Yeah.
And so you saw a lot of people just say, I'm fine with where I'm at. I'm going to stay put.
Yeah. I don't need that extra bedroom. During COVID, it was, right? I need that extra bedroom. Yeah. I need that place. I need an office space. I need a little bit bigger backyard to run around in. We don't want to go to the park and be around people. But that changed.
Is it really worth $1,500 a month? Yeah.
Obviously not. Obviously not, because we saw that the inventory and the supply pulled back. And that's a little bit of a sneak peek to the future is that's what we saw in the market, is that there were less sellers, less buyers, but things actually got better. Yeah. Surprisingly.
Things are getting better. We're going to end today's episode with what we do every single week. We do a real quick mortgage minute and real estate minute, but we figured we'd jump right into this first.
Yeah.
So that's the thing in real estate. What causes real estate to move largely is mortgage rates. Okay. So now what Barry and Dan Habib did was what causes mortgage rates to move. Okay. So in talking about a 2024 forecast, you have to talk about the Fed. Okay. So why would the Fed drop the Fed rate? Well, the Fed's going to drop the Fed rate for two reasons. One, they raised it so rapidly to combat inflation. We've got the data shows that inflation's under control. The other reason why they're going to drop the Fed rate is unemployment rate. So we're going to keep an eye on the unemployment rate. And so I know you know this, Zach, I know this, but on top of mortgage rates moving real estate, really the number one factor in a hot housing market or a cold housing market is unemployment or jobs. Employment, jobs. Yeah. Yep. So they talked a lot about that. I don't want to go too deep into that right now, but
we're going to nerd out a little bit, but we don't have to super nerd out.
Yeah, we'll nerd out a little, but what Dan was talking about during the forecast, the event we had last week, was you have these different Fed chair members across the country, okay? They surveyed 19 Fed chair members about the unemployment rate, projections of the unemployment rate, and the Fed rate in 2024. And 12 out of 19 said that they see the unemployment rate at about 3.8 to 4% in 2024.
Yeah.
And if that is the case, then the Fed will aggressively cut the Fed rate. Now, this is where we hit pause, because I think you need to understand that the Fed rate is not mortgage rates.
No.
Okay. It's not the mortgage rate. Mortgage rates are not directly tied to the Fed rate, but they're indirectly related. Okay. So when the Fed raises or lowers the Fed rate, remember the Fed rate really has an indication or an impact on credit card rates, auto loans, home equity lines of credit,
short-term credit,
like even the return that you'd get on your savings account at a local bank or credit union. So when they drop the Fed rate, they're normally doing that because the economy is slowed. Well, when they make money less expensive, part of making money less expensive is mortgage rates will drop too, and that will speed up the economy. So here are their predictions. 12 out of the 19 Fed chair members say that there's an 87% chance that there will be a Fed rate cut beginning May 1 at the May 1 Fed meeting. Okay, this is May 1, 2024. So this is only a few months away.
And let's say too, in March, 53% chance of a cut then.
Flip a coin.
Yeah.
Okay. And that's kind of them just saying, well, we don't really know where the economy's at right now.
We're still trying to figure
that out. So if we need to, we will. If we don't, we won't. But they did make the Fed met last week, and they were pretty direct in saying that there probably is a lower percent chance that they would raise it. Yeah. So that was the Fed chairman. So then you got June.
Yep.
88% chance on the June 12th meeting. Get this. July 31st, September 18th, November 7th, and December 18th meetings. So you've got 4 months in a row, basically Q4.
100% chance.
So we see this, you guys. This is really important. If you're a home buyer or if you're a homeowner that's been like, you know what, we're in a home. We would like to move, but we're not willing to exchange a 2.875 30-year fixed rate for a 5 or a 6% right now. What you need to understand is this next slide. I'm going to put this up on the screen for you. For if you're listening on the podcast, go over to YouTube and you're going to want to see this. I went back to the 1970s. All the way from 1970 to current. And I overlapped the Fed rate, 30-year fixed rate mortgages, okay, home appreciation, which is Case-Shiller, and then the inflation rate, which is CPI.
Okay.
Forget about the last two, but if you focus on the Fed rate overlapped with mortgage rates every time since 1970, when the Fed dropped the Fed rate after a Fed rate hike. So we just saw a massive Fed rate hike, right?
Yep.
Every single time they dropped the Fed rate, mortgage rates fell right after, and they fell in line with the Fed rate. So
even though they're not directly related, we talked about earlier, they're correlated.
They're correlated, yep. So people always ask me, because I'm in the mortgage industry, Dan, when are we going to see some relief? Because I've got 2 years worth of clients that have 6, 7, 8% 30-year fixed rates.
Yeah.
When are we going to see these drop? We're already starting to see rates drop. We'll talk about this at the end, but we're right in the upper 6s right now.
Yeah, we're kind of same place we were a few months ago.
Yeah.
Right.
We've kind of been hovering in the mid to upper 6s. I think we'll be knocking on the 5% door. And this is what I don't think. This is data
bold
back.
prediction.
Big, bold prediction, but this is data back.
Yep.
But I think we may see a 5, but not in 2024. It's going to be Q1-ish of 2025. Because remember, we go back to the Fed rate drop predictions. Q4 of 2024, 100% chance, right? I think it's going to take a little bit of time. Plus, what else has happened in Q4 of 2024? We're going to have a new president.
Yeah.
Right?
Well, maybe. We might have the same president.
I don't know if the guy.
Hey, we don't need to get into that too much
old,
on this episode. Maybe a future one.
I think that we're going to have some sort of a change there, whether it stays the same or it changes parties. Something's going to happen in November.
There's an election in November.
There's an election, and that'll move them. Listen, I think we did an episode where we talked a little about this. Or we may have just talked about this in an episode. Or no, I posted it on Instagram. That's what I did. That elections don't cause the housing market to go up or down outside of the norm. Elections don't cause mortgage rates to go up or down outside of the norm. But if you look at leading up to elections, typically we get more economic friendly news. Now, we're in a state right now, we just addressed it for the last 5 minutes, that the Fed is going to be in an easing cycle leading up to the election, through the election, and after the election. So
makes sense. You want to look good, right?
All look good, and it's probably going to happen. So I think it's important to understand the Fed rate, unemployment rate, and how they're related to mortgage rates. And so one last thing, we'll kind of get off this mortgage rate thing, is I think it's really important to understand that during recessions, because we will be in a recession this year. And recession, the R word isn't a bad word.
That's a scary word, though.
A lot of people. So why do you think the recession is a scary word?
I think it's just because when I hear the word recession, I think of 2008.
That's it.
I think of, a lot of people struggling, and for a while. And it also just, I don't know, it just sounds bad.
So in my lifetime and in your lifetime, and I know I'm a little older than you.
Your lifetime's a little bit longer than mine.
A little bit longer, but in my lifetime and your lifetime, the only major economic recession that we experienced, I experienced it as an adult. You probably experienced it as a kid, right? What were you doing in 08?
Kid. I was an adult.
Were you an adult? What were
Barely.
You doing in 08?
I was 18.
You're 18. Okay.
I was, yeah.
There you go.
I guess that was
college.
Yeah.
Okay.
Yeah.
So
I was a senior in high school. Juniors. I don't know. I was like a borderline adult, but I wasn't experiencing it like my parents were experiencing it, like right? When they got their house foreclosed on and had to short sell and all that kind of stuff.
America lost their britches during financial britches during that. And so we default to, when you hear the word recession, we default to the most recent economic adverse event, which was 08. Now, that was caused by fraud. That was caused by a lot of external factors that just aren't in the market right now. So I have a lot of data and I have a lot of information that I share with people that proves that the two markets are not the same. But recessions are healthy. Recessions, there's a recession that takes place typically every 10 to 12 years, they say, 8 to 12 years.
Yeah, looking at the graph here that we have, that's what I'm seeing too. You can almost see it. It's almost symmetrical.
Yeah, economies cycle, they go up, they go down. Now here's the good news. With the exception of the '08 recession, home values don't decline during recessions. The other great news, though, during recessions is mortgage rates tend to decline during and after. So we are going to be in a recession because look at what we've gone through over the last couple of years. We've gone through massive inflation.
Yeah.
And massive and cheap money for almost 8 years now, right? So it's important to understand. I want everyone listening to this. When you hear the word recession, or if you hear the word recession on the news or someone talking about it, when I hear the word recession now as a professional, I think of opportunity.
Yeah, me too.
I don't think of scarcity, and I'm not scared like I used to before I truly understood what a recession really was. Yep. Now, I know you want to talk about this average loan to value, because this was an amazing slide. This has nothing really to do with mortgages, but this was kind of profound.
Yeah, well, we were just talking about 2008, right? So I remember my parents were probably in a similar place in 2008 to this graph, but we're seeing 81% is the loan to value ratio, meaning there was 19% equity on average for American homeowners in 2008. That's not very much. That's like less than a 20% down payment across the board.
We're talking, right? People that just bought, but people that have owned for years, right?
Yeah, and I know my parents, they paid $400,000 for their house on the Harbor Point golf course, and that thing was worth probably $800,000 at its peak in 2008, and they had a home equity line. I think they took out a couple different home equity loans or cash out refinances, right? And
like a lot of Americans did.
Yeah, but they were leveraged up to $700,000-800,000 on this, and maybe they had a little equity still, right? Because you can't take out the full amount of equity, but they had a little equity, but it was just based on the value of the property at its peak. And then when things change, now their house is worth less than what they owe on the house. And I think that's what happened to a lot of Americans, right? Even people that owned for a long time, they're like, wow, cheap money.
Yep.
And now we find ourselves in 2023. This is huge.
This is crazy.
42% loan to value, meaning we got 58% equity.
Yeah. Americans have a lot of equity.
That is so much equity.
Yeah.
And people learn their lesson, you'd think, a little bit, right? Hey, maybe I won't take out the max amount if I do a home equity line of credit, or I do a cash out refinance. Maybe I'll take a little bit out to do that project, but I won't completely tap out my house.
So let's talk about the housing market now. So we talked about what moves the housing market with rates, and this is when these economists, when Dan and Barry were talking about the next few slides. This, I think, is important to know for home buyers and homeowners, because if you're a homeowner and you're thinking about selling, you need to know this. Right now, 29% of buyers cite competing offers as first or second barriers to purchase. Meaning, look at this. I mean, homes that are selling 30% of homes. Just in this is
a U.S. stat.
This
isn't Seattle specific. This is U.S. stat.
As of December 31st, 30% of homes bid above asking price. Okay, and I would say that in the Seattle market is probably congruent with that, or maybe even more.
It's probably more.
Yeah.
2.6
offers per home listed. I can tell you from experience right now that that's at least what we see.
Yeah, it was maybe this was. It looks like we have through 2020, like August 2023 on this, right? Because some of this data is a few months old, but the more recent data is starting to see homes are selling on average asking price, right? And even in a lot of cases more. I was talking to an agent the other day, 16 offers on their listing that they just listed last week. Yeah.
That's crazy.
Things are changing, right? This is a little bit old data, and we'll have more data.
Well, consumer confidence is picking up because rates have dropped. We finally saw rates stop increasing, right? And so I think now the consumer is like, okay, now this is my chance. Now here's more data and more information to support. Yes, this is your chance. 39% of buyers cite waiting for lower rates as one of their first or second barriers of purchase. So we saw multiple offers. I'm going to wait because there's too much competition. Now, 39% of them said, I'm going to wait because rates are still too high. Okay, cool. I'm here as a mortgage professional from experience saying higher rates is your best friend.
Yeah,
because you can always go refinance or lower that rate. You can't ever go back and rebuy that house.
Yeah, so I bought a house this year, right? Rates are high. Get a 7% rate, which is actually, looking back, not bad for this year.
Yeah.
I didn't like it because I had a 3.25% rate before at my other house. But I bought my house. The original list price was more than, that's 100,000. I think it was, maybe it was more. It was more than 100,000 above what I paid. So I got it. They did a price cut, and then I got the price down a little bit, even from that. And with lower rates, I would have paid that asking price.
And you got some concessions too from the seller, yeah?
Yeah, and I got some concessions. So I saved myself a lot of money, even though my monthly expense is higher right now for the short term. I saved a lot of money.
Down. Yeah, that will go down. And the price of the home will go up. Now, here's the reason why that price of that home, and what Zach's talking about, is so important, and why I believe that higher rates is a buyer's best friend right now. The National Association of Realtors cited this last month, for every 1% drop in interest rate, 5 million more home buyers become eligible to enter the housing market.
Damn.
Now, that's nationwide. We also have a very populated economy up here too in the Pacific Northwest. So we're going to feel a lot of that. Every 1% drop in rates. So we're starting to see that right now. So I ask you this as a listener. If you see 5 million plus buyers coming into the market with very limited inventory, and the slide that I'm going to share with you next is going to blow your mind on the whole inventory aspect.
Yeah,
do you think that that's going to continue to prop up home values?
Oh, they're going to keep going up.
They're going to keep going up. Yeah. Okay.
They can't not. I mean, we're going to talk about a little sneak peek. We're going to be talking about the supply, right? Whether we like it or not, it's not, the real estate market is not that complicated. It's not.
Basic economics, right?
Supply and demand.
Yeah.
And it's not a national supply and demand. It's a local supply and demand.
And part of that supply cannot be manufactured. I mean, you can build houses. Builders can't build fast enough, but what cripples builders is access to land.
Oh.
We're in certain areas, like not Texas, got plenty of land. Seattle, the Pacific Northwest is a lot different. We boomed and developed. It's tougher to develop.
There's new stuff going on 30, 40 minutes outside of Seattle and Bellevue on the north and south end. There's still space. Not as much as there was. There's not much close in anymore. And a lot of it's urban infill where you tear down something and build something else.
Yeah. Yep.
A good family friend, they're a builder over in Bellevue. You know, they're buying houses for over $1 million, tearing them down and selling $4 million houses. That's crazy. That's not affordable for first-time home buyers. But if you want to live in the core of Bellevue and pretty much, walk to the Bell Square, downtown Bellevue, great. But that's not your starter house. And if you want to buy close in, you're paying a lot of money.
Yeah.
That's the upward pressure on prices.
Yeah. Now, if you're a home buyer, this is what you showed up for today, this one slide. Okay. So we're going to talk about existing home inventory from 1999 to 2023.
Yeah.
I'm going to put this slide up on the screen, and then I'm going to put a link. I'm going to put a link to this whole entire slide deck down below in the description for our podcast as well.
Yeah.
But what you're going to see here in the peak of from 99 to 20 and the end of 2023, the peak was 2007.
Okay. Yep.
There was 4 million listings in America in 2007.
Yep.
And there was 301 million people in America. Okay. 4 million listings, 300 million people.
Yep. So imagine the peak on the graph if you're listening to this.
We're seeing a big peak. To 2023, less than 1 million listings. It was like 897. Okay.
Crazy.
Less than 1 million listings, but get this, 340 million people in America needing housing. So we've got 3 million less homes for sale today and 40 million more people. If that doesn't wake you up and get your attention, that all of this data supporting a strong housing market, I don't know what will.
That's why things aren't crashing.
Well, things aren't crashing because homeowners right now have equity. We talked about that. Homeowners right now, to the tune of 80+% of homeowners right now have a 4.25% or lower 30-year fixed, and they have equity.
Yeah.
So let's say they lose their job, or let's say they get ill, or they get divorced. They're putting it for sale. They're calling you, and you're going to sell their house, and you're going to put some money in their pocket.
Yeah, but it's not a short sale or a foreclosure.
And it's not a distressed sale, which ends up selling for less than owed, right?
Yeah, well, let's talk about that real quick, because what could affect supply and what could bring a lot more sales, homes to the market in the Seattle area specifically, we don't have as much new construction as you're going to see in other markets. So this one, the inventory is going to be existing homes for the most part, and people weren't selling last year, right? You had the usual suspects. You had death, divorce, right? Downsizing, and then people relocating. Those are going to happen no matter how the market's doing. We didn't have the move up buyer. We didn't have the person saying, I'm going to trade my smaller house in for a bigger one, right? We didn't have that happening.
Yeah.
And if we're looking at the numbers, we also aren't seeing foreclosures happening. And that was something we were looking at earlier. So Reuters was talking about the foreclosure data, and we had 1 in 54 Americans.
1 in 54 households in America in 08.
Oh my gosh, in 08, right? So the year after 2007, we're in foreclosure, or had foreclosure notices.
Notice. Yeah. Wow.
What was the number for this year? Wasn't it? It was 1 in 4,600.
Yeah. Look at the difference. Say that again.
So we had 1 in 54 in 2008, right? Right after the peak here.
Yep.
And then in 2023, we had 1 in 4,600 with the foreclosure notice.
Big difference.
So we're not looking or facing a massive influx of foreclosures. Some have predicted that. Oh, we're going to see so many houses flooding the market. Not according to the data.
Not according to the data. And then here's another thing. This is one of those podcasts you probably want to watch on YouTube, but I'm going to put this one up on the screen again. And this is titled, I love how Barry Habib titled this one, Betting Against the Champ. And I actually think this is what we should call our podcast today. Don't bet against the champ and the real estate champ. But
wow, that's a fun name. We'll have to incorporate it.
He went back to 1942. From 1942 to the end of 2023, there was only 6 years since 1942 where home values in America went down or lost. And one of those years was 1990, and it only went down -1%. Okay, and then you had that run from 2007 to 2011, where 07 was -5, 08 was -12%, and then 9, 10, and 11 were -4. If home values went down 4%, I'd actually be okay with that. That's not bad. So, with the exception of one catastrophic year in 08. Housing has just been a massive repeat champion.
Oh yeah,
for years.
Yeah.
And we don't see it. We don't see that changing. And so you've got this data, you guys, that's really supporting. And I wanted to share this with you so you understood the strength of the market, maybe why it's a great time to get in. There are a lot of fears. If you don't know this, sure, there's some fears that the market's going to crash. Anytime someone says the market's going to crash, I always go back to just 6 months ago when I had to lock 8.375 30-year fixed rates. The market didn't crash last year, did it?
It didn't.
The market in the United States of America, the housing market, actually went up nearly 7% year over year last year with 8+% interest rates.
Yeah.
So if that didn't cause the housing market to crash, guys, it's pretty darn strong. Now, one thing that the media, and we're going to wrap up here. We got a couple slides left, but this is big, and I think you need to hear this too. The media is not going to talk about this. The media is going to talk about how much more expensive it is to buy right now than it was in 01.
Yeah.
Than it was in 2000. So
it's negative news.
Negative news, negative media. You plug your ears. Here's the data. So we're going to compare 2021 affordability, housing affordability from 2021 to 2024. The media gets it kind of right. So in 2021, okay, a $500,000 house, a $500,000 loan amount at 2.875 is going to cost you about $2,100 a month. Okay.
Okay.
In 2024, that house is now worth $560,000, and the interest rate's now 6.625. That's going to run you about $3,600 a month. So about $1,500 more a month. The media stops right there, you guys. The media is going to say houses went up in value, rates are up. It's $1,500. The average home in Seattle is now $1,500 more a month than it was in '01. Here's what the media fails to mention. Income has risen 15% since 2021. So that particular buyer in 2021 was making $8,000 a month. Today, they're making $9,200 a month. So if you take a 15% increase in income with a 70% increase in housing payment, check this out. Payment with a higher rate and purchase price is up $1,500 a month, but income's up $1,200 a month. So what's the net?
So fascinating.
It's only $300 more a month. The reality of it is it's $300 to $400 more expensive a month to buy now than it was in 2021. But the media is going to tell you,
wow,
oh my gosh, rates, home values.
This is crazy information. This blew my mind when I heard it the first time.
It's important. You got to understand this stuff. So
let's nail this down with just wealth creation and real estate, right? So both of us have a very similar philosophy to building and accumulating wealth. Number one, you got to have an emergency fund. And this is like Dave Ramsey, but different, right? You got to have that rainy day fund. I like to have 3 to 6 months expenses. I actually have more like a year's worth of expenses. I don't know how much you like to have in cash.
I think as you get older, you need more. Okay. As you have more kids, you need more. So I think I'm in my mid to late 40s. I need a year. If I go down, Zach, do I have a year's worth of savings to cover my monthly expenses?
Yeah, to figure it out or make the shift. Yeah, I think that's huge. And then the next step is maxing out those retirement accounts, right? Yeah. Tax advantaged accounts. The third thing would be investing in the stock market, S&P 500, and other funds. I think real estate's the key piece of that. That as you get to that level, when you're able to, I would throw it right in there as one of the massive wealth building opportunities, maybe even the best one that you have in your tool belt, primary residential real estate. And I mean, let's look at the numbers. This is your thing, but this is a good example, I think, here that it's an $800,000 house, 5% down. Yeah. Can you help us kind of look at this as an investment?
So I agree 100% with what you just said on the 4 quadrants to wealth. It's really simple. Emergency fund, max out your 401k, IRAs, buy residential real estate, whatever is left, throw it into the S&P 500 index, get it with a financial planner. This is not financial advice by any means, but this is just what a couple of wealthy people have taught me, and I followed it, and I'm 47 and it's working. And I know you're much younger than me, and I know it's the same program is working for you.
33, I've been following it, and it's working for me too.
It's working. So the fourth part of this is owning a piece of residential real estate. I mean, it doesn't have to go in any specific order. I like to see my clients have a rainy day fund before they actually buy their first house. But 401k, IRA, S&P 500, all that stuff, this is a part of a bigger plan. But I'm a big advocate. You got to own real estate, and you got to get in the game as soon as possible. So check this out, okay? I believe with 100% of my being, and I tell every single client that I meet this, you can't, no matter what market, no matter what vehicle, you can't out-earn appreciation. Let me say that again. You cannot out-earn or out-save appreciation.
That's true.
And I'm going to prove this to you right now.
Let's do it.
We just went back and showed you from the 1940s to current. We showed you in one of the toughest housing markets that we've seen, that I've seen in my 15, 16-year career, which was last year, home values still went up at 7%. Let me say that this year, let's just say, for example, that home values only go up 5% this year. I think they're going to go up a lot more because rates are going to be lower. But if you bought an $800,000 home, you put 5% down, which is $40,000. Let's say your total closing costs were $16,000. So your upfront investment, about $56,000. Okay. But that $800,000 home appreciates, like I said, at 5%. Probably will appreciate more, but let's just say it appreciates at 5%. You just made $40,000 in appreciation in 1 year.
Okay.
Your upfront investment was $56,000. You made $40,000 in 1 year. In 1 year, your ROI, your return on investment, was north of 70%. Okay. So now let's go back, Zach.
That's going to kick the stock market's butt.
Well, the S&P 500, that's what every financial planner investor wants to try to beat. The S&P 500 last year was up north of 20%, but that's not normal. Over the last 40 years, the S&P 500, let's just say, is averaged 7 or 8%.
Yeah, but let's say it was up that much because it was down like 28% the year before. Yeah, it didn't even. I mean, it was recovering.
But that's why we look at long-term averages.
But long-term averages 7%. 7% is really conservative. Yeah.
So you take that $56,000 and you invest it in the S&P 500. In 1 year, you're probably going to make about $3,000. Same 56,000 invested in the S&P 500. Same 56,000 invested tied to a vehicle called a house that's worth $800,000. The $800,000 vehicle goes up in value, not the $56,000 asset, right? The money, the capital. So at the end of the day, so big on owning real estate. This is what I tell every first-time home buyer: buy real estate, get in the game. Now, it's not the end all, but if you got in the game and then go back to what you were talking about, the 4 quadrants of wealth, buy real estate, okay? Do what you can to max out your 401k, especially if your employer wants to help.
Oh, for sure.
And then have that rainy day account, and then anything that's left over, go put that into the S&P 500, and you do that for 20 years, and you will not have to worry about retirement.
Yeah, it's crazy. And looking at this, thinking about, if you put your money in the stock market, for the most part, you're not leveraging yourself at all, right? You're just putting the money in. It's all cash. Same thing if you owned a house outright, you're not going to see the same type of return on investment. But because your primary residence is leveraged, and you can leverage other real estate as well. But in this example, we're talking about a primary residence putting 5% down. You're able to capture the full appreciation of the asset with only the 5% down, plus your closing costs.
Big time leverage. Yeah.
And you got to pay to live somewhere anyway. So you're going to be paying your monthly, you're going to pay rent and utilities.
Now, if you really want to put this on steroids or on some juice, you turn it and become an investor, and you own multiple homes. And I've seen a lot of people, including myself, do that. And it's just another way to stack the chips in your favor, right? And you know that if you know that it's going to go up X number percent, and you know that your house is worth X, and you know that you only need X to get in, it's just a numbers game, and you put a renter in there. The renter's got to pay to live somewhere. So, guys, as we conclude, the slide deck that we just shared with you was from Barry Habib.
Yep.
I want to give him credit, and he's a guy that I listen to him every single morning. This is how I learned to give my clients great advice on the mortgage market and real estate. I added a final slide to this, and it was Warren Buffett, arguably one of the richest people in America. And he's known for investing in businesses and investing in the stock market. But I got an interview here where he was on CNBC, and he actually talked about residential real estate. And he said, if I was a first-time home buyer, I would buy real estate with a 30-year mortgage. And he was like, it's the only way, it's the number one way to short the US dollar. It's protection, it's your hedge against inflation. I'm going to provide the link. If this is on YouTube, I'll put it in the description. I'll see if we can drop this in on a podcast too. But I encourage you to listen. It's a 1.5 minute interview.
Yeah, it was a fascinating interview. He like you said, he doesn't normally talk about real estate and investing in real estate. So it was interesting to hear his perspective.
Yeah, it's pretty good.
And how it's shifted too. And he's trying to, analyze, hey, where are we at right now, and take those lessons he's learned and apply that. So
80 years of a lot of wisdom. So let's close with our mortgage and our real estate update real quick in 60 seconds or less. You want me to jump on the mortgage side?
Why don't you jump on the mortgage thing?
Cool. Yeah. So mortgage rates up 1/8 week over week. There's no rhyme or reason. Jobs report came out. They're trying to decipher through some of the meanings of that. The Fed chair spoke last week, was pretty bland on what they said. So I think the markets are just trying to figure things out right now, but nothing to be concerned with. 30-year fixed rates right around 6.8%. It's not a quote, it's just a range.
Yeah, Mortgage News Daily, right?
Yeah, Mortgage News Daily, and it's better than the 7 and 8% range where we've been over the last year. So good stuff.
And I mean, looking at King and Snohomish County prices here in the Seattle area, we saw in Snohomish County, the median sales price was up 1.5% year over year. 5.5% was the average. And King County, we're looking at something similar, 7.8% median sales price increase and 12% average increase over the last year. So, and those numbers aren't perfect maps to where the market is, but they're sure as heck a great indicator, at least on a monthly basis, something to pay attention to and follow. And just seeing here as well that homes are selling for 99.7% of asking price on average is showing like, hey, things are getting better. And the supply number, we talked about that.
Yeah.
Right. On a national level now, looking at a local level, 0.9 months of supply, 0.6 months. It's a hyper seller's market. There's no inventory. So if the interest rates come down, it's going to be a really crazy spring and summer here in Seattle.
Well, you and I never use this platform to sell. We use this platform to educate.
Yep.
And if I could just have one little pitch real quick, if you have questions on any of this stuff, even if you're thinking 1 or 2 years out, we do this to provide commentary, to provide education, to keep you current. But if you have any questions, reach out to Zach and I. If you're thinking, if you wanted to sell, if you're in a house that you're not thrilled about, but you just feel like they call them the golden handcuffs right now. You're in a house, you've got equity, you wouldn't mind selling. You just don't know. Sit down with one or both of us and we'll run you through a little strategy session, put everything out on the table and give you some advice. Maybe you'll learn something. So we're here to help if you have any questions.
Yeah, I echo that. Thanks for sharing that, Dan. I think that's why we're here. We want to bring value to people, and sometimes that's information that's more broad. Sometimes that's a little bit more personal. So I guess we'll wrap up with that. Goodbye, Seattle.